All right, should be ready to rock and roll. So welcome. This is a Q1 market update. So I'm going to be going over some of the action we've seen in the economy in the last few months, kind of give an updated forecast, and then we'll talk about real estate. Specifically, we'll talk about multifamily and that asset class and what the performance has been. And then I'll do a quick overview of some of the other asset classes out there and kind of what my thoughts are based on some of the reports I've read. So Elisa, sorry, I can't recall. I thought after I said Eliza, I was like, that doesn't sound right. But Alyssa. All right, let's get into it. I'm going to share my screen and got some slides prepared, and we'll get into it. Elisa. All right. Great. Johnson, welcome. Henry, welcome. All right, let's get into it. So this is, like I said, this is the Q1 market update. So I'm going to be going over the performance of the economy so far in 2021, what we're expecting going forward, and as it relates to the real estate markets, how multifamily is performing, and we'll talk about some other asset classes. So a little housekeeping. So if you have questions, you can put them in the chat box, you can put them in the Q&A box, and we'll have time to answer them at the end of the presentation. Of course, none of this is it's all believed to be reliable. I've compiled it from various sources, namely market reports and economic reports, but I can't make any warranties to the accuracy. Nothing in here is considered an offering, and the replay will be available typically about 24, 48 hours, depends how long it takes to render and get uploaded to YouTube and whatnot. So, all right, so this is what we'll be going over today. Sorry about that. And let's do it. All right, so a bit about myself. So originally I'm from the Boston area. So I grew up there and I got an RTC scholarship out of college. So that led me down the path of becoming an Air Force officer. So I went into the aviation track. I flew the B-1 bomber. So I did that. I was active duty for 8 years and met a lot of great people. And then ultimately made the decision to exit the Air Force and pursue other opportunities. And one of those opportunities is real estate. So real estate is something that I started investing in back in 2011. So I moved up to South Dakota for my first combat duty station. And I bought a duplex. I was tired of renting. I'd been renting for a few years after college. Decided I wanted to start building equity and start becoming a homeowner. So I bought a duplex and I did what's called house hacking. So I had a renter in one side, and then me and a roommate lived in the other side. So between the two of them paying me rent, all my bills were paid for. So that's what my first introduction to real estate was, and even investment real estate. So a couple of years after that, I decided that was going well. I got another duplex, and a couple of years later, I got another duplex, and so on. So by the time I left the Air Force, I took the first year I was out, I took off. I wanted to do some traveling. I lived in Munich for a little bit, and I just kind of wanted to decompress, figure out where I was going in life. And I had these rental properties kicking off cash flow every month. So I realized that it was really the only thing that I took with me from the Air Force. I didn't have a pension. Usually people associate the Air Force, you get this great pension after 20 years, but you get to stay in the full 20. You don't get a partial at 8 years. So I had nothing other than those rentals and whatever I invested in the stock market, which wasn't really performing great, right? So that's what started getting the gears turning about investing in real estate more and really doing it full time as a full time profession and working towards financial independence, financial freedom, because ultimately the life I want is not one where I'm tied into a certain job or company, but to choose my own path, to choose my own working hours. If I want to take a vacation, I don't want to have to answer to anyone or anything like that, right? So That is the path I'm on now. I was very fortunate that I got into cryptocurrencies back in 2013 is when I first started investing in Bitcoin and Ethereum. And I really haven't touched it until this year. So this is the first year with Bitcoin where it's at today, somewhere in the mid 50s, that I'm starting to look at transitioning some of that portfolio into real estate to capture that equity and start producing cash flow, right? Because cryptocurrency, you can't cash flow. It's a liquid asset, but it's not cash flow producing. So I want to put it into real estate, get advantage of the taxes, the cash flow, and everything that comes with real estate. So that's kind of my personal goal for the next year or two. And of course, I operate under my company Mach 1 Equity, providing syndications and passive investment opportunities to other investors. Here's some of my active projects. So Glen Oaks on the left there, that's a 232 unit apartment complex that we closed on about a month ago. So that is a Class C, Class B apartment complex that was a value add, pretty heavy value add. There was some occupancy issues. It was basically being mismanaged, and there was some neglect. It had a lot of deferred maintenance and opportunities to renovate. So that is the big value add there with that project. So we're really excited about that. Actually, in a couple hours, I've got our partner call for kind of our 1 month review of the performance of the property over our first month of ownership. So really excited to see how that's performing over the past month. The rendering you see to the right is of a Class A office building that my partner and I are developing in Loveland, Colorado. So really excited about that. That's definitely been a challenge. We were getting ready to kick off right as COVID hit. So we hit the brakes while that pandemic kind of played itself out a little bit, and it really, cost us a lot of time. And a big challenge with that has been the rising price of materials and subcontractors. So lumber for sure is up, 200%, but really everything is up. So that has been a challenge, but great learning experience. And I think medical is a great asset class. So very happy to have taken that leap when we did, because I think the asset class actually is appreciated since COVID hit. So not too bad there. All right. So let's take a look. Let's start with some economic indicators. So this is actually a slide from my 2021 forecast I did back in January. And I thought it'd be cool to just start off here. This is kind of the baseline of what we were expecting for 2021. So we were expecting in January 3.5% growth for 2021, expecting inflation to be just over 2%, unemployment to end the year around 6%, and interest rates to basically stay the same at 0. So I just wanted to throw that in there because I thought it was really interesting to see how far we've come in just a few months from those numbers. So let's look at what we've seen over the past quarter and what that leads us to assume for the year ahead. All right. So March was a big month economically. So we added 916,000 jobs. So the jobs market jobs are back, baby. The market's on fire. It blew through expectations. I think the expectation for March job growth was about 600,000, somewhere around there. So it far exceeded that. And it was the strongest month since August of last year, which was, kind of in that dead cat bounce range of, we had these massive layoffs as the pandemic hit and businesses were shut down. A lot of them were temporary though. So a lot of those jobs came back in, June, July, August. So we had these huge gains those months, but then we saw it quickly tapered off. And you can see, we hit the low point in December where we actually lost jobs. So we had definitely a challenging winter economically, but now it seems like things are back. We're full steam ahead, and we're on track for a strong recovery in 2021. Now, granted, we still have a long way to go. We're still probably about 8 million jobs below where we were last February, pre-pandemic, but adding close to 1 million jobs in March definitely puts us on the right track. The largest gain was in leisure and hospitality, so hotels and that sector coming back strong with 280,000 jobs added. And construction's been really strong in the last few months, so that's up 110,000 jobs, which is their strongest month since June. So those gains brought the unemployment rate down to 6%, which if you recall from the previous slide, that was the goal to end 2021 was around 6%. So we've already met that. Granted, true unemployment is about 10.7%. So that factors in your underemployed or people that maybe are working multiple low-paying jobs, but they should be in a higher-paying job or something like that. Or people that are employed part-time but want to be employed full-time, right? So, and also another caveat is the labor force has shrunk by several million. So we're looking for that labor force to grow over the next year. But still, we're seeing movement, and that's the positive thing. So looking ahead, what do we want to see? What do we expect to see for 2021? I'd like to see job growth of about 400,000 to 600,000 on average per month. I think if we're hitting those numbers, then we're ending 2021 really strongly in terms of jobs growth and the jobs market. And that's going to be really good for long-term economic health. One thing to point out is the disparity in terms of the effect of this downturn across classes. So you can see the lower wage earners there in that gray line on that chart. They're still sitting at about 18% less employment than at the start of the pandemic. So they were hit the hardest. I mean, you can see in April, almost 50% of them lost their job temporarily. So they've made a lot of gains back. They're up above 20% loss, but still nothing compared to, the high and medium earners that were marginally affected, 3-4% max. But it's those lower income earners that are really affected. So this is why they say it's called a K-shaped recovery, because the higher earners, the white collar class, they're doing better than ever. It's that lower class, the low wage earners, the hourly earners that are still struggling. They're hit the hardest. I mean, you think about people that are in service like waiters and waitresses and bartenders that have dealt with social distancing and restrictions on indoor dining, things like that. A lot of them were left out in the cold, literally and figuratively. So there's still some of that, but if we can keep up with that pace, then that's going to be encouraging for that demographic. So what does this mean in terms of GDP? So 2020, we saw GDP contract by about 3.5%, which certainly not good, but I think it could have been a lot worse. Some of the tailwinds behind keeping it from being worse were we actually had a really strong retail year. So people were buying goods. So basically what happened was there was a huge cutoff or dip in spending on services, but people were buying a lot of goods. Some of that was maybe like stocking up on things and things like that. But overall, retail was really strong. E-commerce had a really great year. They added about 20% market share. So that helped stop some of the bleeding. And then, of course, there was stimulus and aid, which was a big factor in propping up the economy and keeping things afloat while we worked through the pandemic. So that's led us to Q1, which we saw GDP increase about 5.9%. So that's really encouraging. If you recall that first slide, GDP forecast for 2021 was 3.5%. So Q1 coming in at 5.9%, we're almost double what we were projecting a few months ago, right? So, and that's Q1. We actually expect Q2 and Q3 to really heat up because that's when we're going to see consumer spending pick up. We'll talk about that more in a later slide, but overall, the things driving that are we've got a lot warmer weather, so that opens up the opportunity for outdoor dining and utilizing outdoor space, things like that. And then, of course, the vaccine rollout has ramped up, and we're working towards herd immunity, which is going to allow us to open up the economy, right? So that's left us with a forecast for 2021 of 6.5 is where the Fed is at. So the Fed actually upped their projection in December. They were calling for about 4.2%, I think. They upped it to 6.5%. And a lot of that was based on the passing of the most recent stimulus, the American Rescue Plan. That was the $1.9 trillion plan that Biden got passed. but some people are calling for, 8-9% growth. So what we're looking for in 2020 is potentially the strongest year in terms of growth, and since like the post-war era. In case in point, you can see that chart on the right. That is, the blue line is dining out, and the red line is airport passenger. So you can see they're still, for travel, they're still down about 37% from where they were pre-pandemic. And that's going to take a little bit longer to come back, just because I think there's still a lot of uncertainty amongst travelers. No one wants to book a vacation to Disney World and then find out that maybe there's limited services there because they're not fully spun up yet, or maybe something happens where another strand of the vaccine comes out that the disease comes out that the vaccine doesn't apply to, or something crazy like that. So some of the travel is going to take a little bit longer to come back, maybe a year or two, but the dining that's already recovered from basically 100% loss a year ago to now it's only down about 20% from where it started. That is probably going to recover this summer, I think. As we move along, the vaccine is out. I think people are sick and tired of being cooped up and getting takeout every weekend. People want to go out. People want to spend their money. I think we're going to see dining bounce back and make a full recovery by this summer. Short of course, some restaurants won't recover because of the damage that was caused. But overall, I think people will be back to eating out. So, all right. Really, I just want an excuse to put this slide in because I just think it's a funny picture of him. But the Biden effect. So how much of an effect has he had personally? I think is probably minimal, but certainly the people he has put in place of some of these programs, specifically the vaccine rollout, is a big one. Start off with this abysmal rollout. I think they were averaging, 200, 300,000 vaccines a day. Their goal was like 1 million a day. But to their credit, they did fix the glitch, if you will, after, a month or so of some growing pains there, and they got things on track. And now the vaccine rollout is overall a giant success. So legislation wise, so this is another slide that I stole from my 2021 forecast, because I thought it would be cool just to see the side by side of what was proposed and what they actually got. So this is what was proposed, and then this is what they got. So this is what the American Rescue Plan included. So they got the $1,400 checks, which was the big one, right? And those went out to everybody that made 75,000 or less, or if you're a couple, it's 150,000 or less. And then, there's some more details with that, but generally that's what it was. The unemployment insurance supplement. So this is the extra $300 a week benefit that got extended through September. They were asking 400, settled on 300, but still that's not bad. $300 a week, I think, goes a long way and has a vast economic impact overall. I think getting that money into the hands, the lowest common denominator, get it into the people's hands is always can have an economic boost. And then they did extend the eviction ban through June, but to be honest, from what I've heard, it doesn't sound like there's a lot of teeth to that eviction ban in terms of its application. So I don't know that that's a huge deal. Rental assistance, I think they're asking 30 billion. They got 21.6, but there was also potentially up to 18 billion in mortgage assistance. So how that stuff gets doled out is probably going to be the limiting factor. Is probably a lot of red tape and bureaucracy. But overall, rental assistance is good for real estate, right? You want people paying their rents. And of course, the $15 minimum wage didn't get in there, but I don't think Biden's administration was really pushing that hard for that. But either way, there was a lot of discussion about it leading up to it. Now the vaccine. So this was the big one. So this is the thing that I think is really moving the needle in 2021. The stimulus, all that stuff is great, but that's kind of a Band-Aid. That's the bilge pump in the boat. But if you got a leaky boat, yeah, the bilge pump will buy you some time, but it's at a certain point, it's going to become overwhelmed, right? The vaccine, that's really going to be stopping the leak, right? So I think I had on the previous side, they were asking for 400 billion for that, but I think there might have been a misunderstanding there, maybe on my part or some article I read, because what they actually got was 105 billion for health and 123 billion for COVID response. And then within that COVID response was, I think, like 15 billion or 10 billion for vaccine distribution specifically. But it's hard to track some of these bills, where the money's going and coming from, because they put a lot of pork in, they put in a lot of stuff that really has nothing to do with an American rescue plan. It's just like stuff that should be in a normal bill, like whatever it is, research grants, things like that. They just kind of pile everything in, helicopters, jets, whatever they deem necessary or they can get away with. But the bottom line is 200 million people have been vaccinated within the first 100 days of him taking office. So his goal was 100 million in the first 100 days. They 2x that. So that's where you can really see they turned around that botched rollout. And now it's ultimately a success. There was some hiccups with who was it Pfizer? Whoever it was, one of the vaccines that just last week they pulled from the shelves because I think there was some clotting issues or something with a few people. But overall, very successful. And that's what's going to allow us to achieve herd immunity in the spring and early summer. And that's going to lead to this massive economic boom in Q3 and Q4. So that's where we're going to see this surge in spending and activity as things really open up and go back to normal, right? Here's a breakdown of the ARP. If you're interested, I'm not going to go through line by line, but bottom line, 400 billion in stimulus checks specifically making its way directly into people's pockets in the economy. I think is the biggest boon for the economy, and that's what's going to go the furthest. Now, let's talk about consumer spending. So if you've ever seen my economic discussions before, I always hit on this, that about 70% of the economy is reliant on consumer spending. That's the driving force behind 70% of the economy. So it's huge when it comes to moving the needle. And we get a couple things going on right now that lead us to confidently say we're going to see this massive explosion of spending in the summer. One of those things is household net worth has grown dramatically over the pandemic to the tune of $13 trillion. Now, main driving force behind that is home value appreciation. So the single family home sector has gone gangbusters. Nobody can buy a house. They're going for 100,000, 200,000 over asking price. So there's a lot of equity that's being built up for homeowners, and they're, the big gainers of this boost in the market. Granted, a lot of that is illiquid and it's not going to be captured. So it's really just kind of phantom equity, but there is going to be a lot of people to capture it through sales. Refinances is very popular right now. Those have seen a dramatic rise, as well as interest rates have come down. So there is a lot of refinancing going on, and probably some HELOCs as well. So some of that will be captured, but the big one is savings and the stimulus payments going to people. So what we saw was a massive uptick in personal savings throughout the pandemic. A lot of that is being driven because people didn't have the opportunity to spend, right? We sort of took that opportunity away when we got rid of basically any sort of live event, restrictions on eating out, things like that. Heck, even some of these curfews and things we're seeing. So basically shutting down the opportunity for people to spend money, force them to save that money. And then there was a lot of people that, because of the economic uncertainty, were increasing their savings rate anyways, just out of an abundance of caution. And just kind of saving up for, hey, I'll take a trip or I'll do something fun when this is all over. For now, I'm just going to sock it away, put it into the market, or put it into my savings, and come out the other side better and stronger. So that's what we've seen a lot, to the tune of several $1 trillion making it into people's savings accounts. But now, as we head into the summer, we're ready for that summer spending spree, right? Say that 5 times fast, summer spending spree. So there's a ton of pent up demand. People want to spend. I've even heard on some some webinars, they're calling it revenge spending, right? People are like, finally, I can get out of the house and spend money on stuff. So they're taking it to another level, if you will, I guess. I think I was on a webinar last week and they were talking about, I think it was in Melbourne in Australia, where they're pretty much full up because they don't, I guess, don't have as much of an issue with the virus over there. So they were talking about, the primary mall in the city of Melbourne had more shoppers than Christmas Eve. So people are shopping with a vengeance, if you will, right? Because now they have that opportunity. As I alluded to, the winter was harsh for a lot of reasons. One, because we saw spiking cases, so that reinstituted a lot of those kind of lockdowns or restrictions. But also the weather. If you're a restaurant owner and you're reliant on that outdoor seating, well, no one wants to eat dinner in the middle of the winter outside, right? So there was a loss there that they dealt with, but now the weather is nicer. We're moving towards herd immunity. So the summer is really where the dam is going to break and unleash that spending. So then that leads into this question of inflation. Isn't this uptick in spending and all this money working its way in the economy, isn't that going to lead to rising inflation? And it's an unequivocal yes, for sure. So some of the things driving that, we've got about $6 trillion worth of stimulus and aid has been sent out since the start of the pandemic. Now they're also proposing a $2.3 trillion infrastructure plan. So that's making its way into the expectations for inflation. And overall, what we've seen over the past years, the M2, so that's the money supply, if you will, is up 27% year over year. So that's how much additional cash the government has created, basically. So all of this is going to combine to lead to rising inflation, which we're already seeing. And then, of course, like I said, with consumers, we have surging demand for goods and services, specifically services spending. We're going to see skyrocket. Goods have already been strong, but we're going to see rising services spending. But for producers and suppliers and manufacturers, what they're dealing with is a lot of increased input costs. They've had supply chain constraints and disruptions over the past year that depleted the inventories, and they've struggled to resupply those inventories back to their pre-COVID levels. So that's increased pricing power, and it's led to rising prices. And there's a lot of companies that are basically telling consumers, we're going to be raising prices over the next year. I was reading a report today. Procter & Gamble is expecting basically, I think across the board, pretty much like a 5 or 10% price increase for their products. Shake Shack increasing prices 5%. And just, there's like a list of companies that were announcing pricing increases. So it's already starting to happen. And then soaring commodity prices as well. Oil is up from negative 30 a barrel or whatever it was during its infamous dip there, but it's up to about $60 a barrel now. And lumber, as I said earlier, 200% or something. So all that's going to factor into rising prices. And right now what we're seeing is about 2.6% year over year in March. So the question is that transitory? Is it long-term? The Fed, if you listen to Jay Powell, the chairman of the Fed, he's saying it's going to be transitory. So the read there is basically that they're not going to touch interest rates unless they see inflation exceeding 2% for an extended period of time. So just a few months above 2%, they're not going to make any moves or adjustments. He wants it to average out to about 2%. They're accepting higher. So, we could see 3-4% this summer. Of course, I'll caveat that with a lot of these, when you look into how they calculate inflation, it's kind of bullshit, a lot of it, to be frank with you. They're looking at the price of milk and coffee and bread or whatever, but it doesn't do a good job of factoring in, well, how much more efficient have the manufacturers gotten to making a gallon of milk over the last 40 years, right? I mean, those industries have probably completely reformed in that time technologically and improve their margins. So if the margin has improved by 50% and the cost has only gone up by 10%, well, what's the inflation really at, right? So inflation's a wonky thing to discuss, but we're definitely already seeing it. Asset inflation, the stock market for sure. All that money pouring into the stock market led to, this. I mean, 2020 was like a great year to be in the stock market, even though we're dealing with all this. So definitely already seeing signs of that inflation. So that's the economy. So overall, bottom line, 2021, we're looking at, it's going to be a very strong recovery over the spring, summer, and fall. And we should be heading into 2022 looking quite well. Let's look at real estate. So the big discussion around real estate, specifically multifamily, is migration patterns. So this was something that the trend was already existed for people moving out of these high cost of living markets like California, Massachusetts, New York, and into the lower cost of living markets or the more tax-friendly markets. Florida, Texas have been big beneficiaries because they don't have an income tax. So if you're coming from California or New York where they have high income tax and they're talking about raising it even more, even though they're losing everybody, it makes sense why we're seeing all this migration, right? Especially to some of these emerging tech hubs that are starting to distinguish themselves. So these are the top 10 winners and losers. Not too many surprises. Maybe South Dakota in the top 5 is a little bit surprising, but low cost of living market. Ohio in the bottom 10 is a little bit surprising to me. It's Ohio, and then Kansas too. But overall, about what you'd expect: the Carolinas, Florida, Tennessee, Arizona being the big inbound states. And then this is a big effect of it, is the effect on basically the urban core apartments have been faring the worst because that's where people are fleeing, because there's also migration out of cities into the suburbs. So it's kind of a twofer. But the good news is a bottom is formed. So this is from Yardi Matrix. They put out great stuff. My friends over there. So you can see in February and March where you see that slight uptake. So at least they bottomed out and now they're in recovery phase after a year of declining performance, because people were getting out of those studios and 1-bedroom apartments and moving to wherever. Someone moving in with their parents in the suburbs or moving to a lower cost of living market because now they can work from home and kind of play that arbitrage there. And then this just kind of hammers it home again, so you can see that the 2020 to 2025 outlook for young adults is that the downtowns are going to see a decrease in their population growth, and the suburbs will continue to rise. But you're talking fractions of a percent. So what the net effect of that is, I guess we'll see. All right, this was an interesting one. So this is rent and occupancy growth, highest in emerging tech market. So what this is the left is your year-over-year rent growth, and then the bottom axis is the occupancy change, and then the blue lines are your average, for national average. So highlighted in those blue boxes are the gateway expensive markets. So pretty much what you'd expect performance-wise. Loss of occupancy and negative rent growth. And then in the top right, you can tell you have your more, emerging tech hub markets performing really well. But there was a couple that I wanted to highlight. So Huntsville in particular, Huntsville, look at that rent growth up at, 7-8%, something like that. Which Huntsville was always kind of performing well, but that one surprised me. That's just really strong rent growth. They have a growing space sector, I guess you could call it, with some of the space industry companies based out of Huntsville. But the one that really caught my eye was Albuquerque. So I was actually on an investor call on Friday with someone. We were talking about markets, and I was telling her about some of the markets I like. The Carolinas for sure, Charlotte, Raleigh, basically South and North Carolina are getting a lot of inbound migration, so I like them. But she's like, well, what are the more, low cost, low entry point markets that you think are like the next ones? And I said, well, maybe Albuquerque. I think Albuquerque is really interesting because it's in that Sun Belt, but it hasn't really seen the growth or attention that some of these other cities have seen, like, Tucson or Austin or whatever. But it's right there. It's a 1 million-person city. And I've always been hesitant to really lean into Albuquerque because of the high crime. And they have like an abysmal high school graduation rate. I think they're 49th or 50th in the country. So they have issues, they have problems, but that rent growth, I mean, that's 6-7% for Albuquerque. And they've been showing up on these types of lists for the last year or two, over 4 or 5%. So I don't know what's going on in Albuquerque that's causing that rise in rent, because it doesn't seem like there's that much that's encouraging, because like I said, the crime is still really high. They have an education problem, they have a corruption problem, but that's, I think, one to start taking a serious look at if that continues, because you're getting in an attractive price point compared to the rest of the country, and that rent growth is solid. Tulsa as well, I think it coming in at like 4.5% with that rising occupancy makes those attractive to me. So definitely make note of those. And then overall, you just see the performance of real estate throughout the pandemic has held up. This is specifically multifamily rent collections. So yeah, there was a 1.5-2% decline in collections compared to the years prior, but overall performing really steadily, and will continue to do so, especially with the recent stimulus that adds a little more surety that people will be able to pay their rent. And then, of course, jobs are coming back. We're seeing growth, things like that. So the outlook is positive. Apartment prices marginally increased, not much, and cap rates were pretty much steady during the pandemic. The average national cap rate is like 5.1%. That chart on the right I thought was interesting, comparing apartment price indexes for garden style apartments versus mid and high rise. And you can see that at the end of 2020, garden finally eclipsed those mid and high rise. So that trend had been developing for a few years, where the mid high rise had kind of topped out and were declining. But I think we're going to see that a little bit more apparent in the next year to come, because those garden style apartments continue to be very attractive. It has that more, I guess, suburban feel. So even if you live in a city, maybe it's more attractive for someone that wants a little bit more space, maybe get a little terrace or something, versus a mid or high rise where you're just getting your box or whatever. So overall, thumbs up for multifamily. It's a steady performer. It's a solid, consistent performer, and the outlook is good for the future. It's going to continue to have high demand. It's still a struggle to build, especially that Class B asset class for multifamily. It's impossible to build, so they're building luxury, but the demand is steady. In fact, the demand is rising as home prices go up. It continues to price people out of the market, so they have to stay renters for longer. So it's still going to be a good asset class. I don't know that it's going to be the best performing asset class of the next decade, because I think it's already gotten so much attention over the last decade, so much money to it, that now people are starting to chase yield in other asset classes, which we'll talk about as well. But overall, I think it's solid. I think it's steady still. I like it. I love it. Let's buy some. All right, a little single family shout out. I didn't want to go into all the nitty gritty of single family because everyone knows it's been gangbusters this past year. Single families on fire. It's melting down. So it's 13% year over year median sale price growth from January 2021 to 2020. So, and that's continuing to rise in the last quarter. So, yeah, and I just don't see it slowing down anytime soon. It's just been wild to watch. All right, let's real quick. We'll talk about a couple other assets. I'll just kind of hit the highlights and just what my top of mind thoughts are, and then we'll wrap it up and go into the Q&A. So office has seen, obviously it's struggling year for office. Vacancy is up 3 or 4%. Net absorption was down, I think 90 million in square feet in 2020, and you can see down 41 million in the first quarter of 2021. So there's a demand issue there, but they still saw rent growth of 5%. So that surprised me a little bit. I don't know if that's being propped up a little bit by maybe some of the tertiary markets or suburban markets that are seeing a little bit more activity or attention from employers moving to those markets. But certainly your core office market is going to continue to struggle for the next year. So I'm giving that a thumbs down. I think it's still too risky for most people. I think that overall the work from home phenomenon, if you want to call it that, in some ways is being overstated, because you're going to see this return to office because, I mean, you can't recreate the collaborative properties of an office over Zoom. You know, you can just, especially certain jobs. There are certain jobs that lend themselves to work from home. If you're just kind of coding or doing some sort of customer service type of thing, yeah, you can do a lot of that from home. I think there's a lot of industries that are going to go to a shared model where you're in the office 3 or 4 days a week, and then you're at home 1 or 2 days a week. So over the next 1 or 2 years, I think a lot of companies are going to shrink their leased space by 10 or 20%. So that's going to have an effect on the overall market because companies are going to need less space, but a lot of companies are still going to be in the office. I mean, just the ability to bounce ideas off of whatever it is, 5, 10, 15 person team, and have them immediately throw spears at it or shut it down, or, you know, add on top of it, piggyback on it, and come up with ideas, I think is invaluable. And then of course, just the face-to-face aspects of certain things like sales. I mean, if you're in a corporate sales type thing where you're courting customers for some, you know, could be a $3 million account. Sometimes they court them for 6 months before they sign. They're going to be taking them out to dinners and lunch because their competitors are. So there's going to be a competitive nature that takes over. And then also, just speaking of competitiveness, if you work in an office and you get FaceTime with your boss, you're going to have a leg up on the guy that's sitting at home in his underwear on Zoom, because your boss is going to hit you with those tasks that come up randomly and throughout the course of a day. And now they're reliant on you, and they start to, you know, establish a relationship with you, you know, so you're going to be set up for promotions, things like that. So that's my thoughts on office. I think it's kind of a wait and see for now. Retail, much of the same, similar story there. Vacancy is up. Absorption is negative in 2020. Rents are down and construction is down. So overall, retail also a bit struggling. E-commerce, the rise of that, it's not going to wipe out brick and mortar, but I mean, e-commerce grew by 20% in 2020. So the trend is speeding up. Granted, a lot of retail, like strip malls and stuff like that, they're going to do really well by providing services-based tenants. You know, things like, I don't know, a dry cleaner. They're not going anywhere. You're not doing that over e-commerce, right? You know, even some excuse me, like food and beverage and stuff like that isn't going anywhere. So retail, definitely some struggles there, especially if it's kind of like a Class C or less than ideal strip center, whereas the better ones down the street, that's, you know, maybe was a Class B and this one was a Class C or something, you're going to see maybe some movement from tenants. Would be my assumption. So overall, I give that a thumbs down. Now I'll caveat with, and the same goes for office, there's going to be huge winners out of this, because when you have distressed asset classes like this, there's people that can turn it around and can capitalize on that. There's opportunity in that, right? So it's kind of like, they say a rising tide lifts all ships. Well, there is stormy waters in office and retail right now, but just think about if you've ever seen Forrest Gump, right? Everyone's seen Forrest Gump. When he starts shrimping, initially he's struggling. He can't catch 2 shrimp and an empty beer can to cash in for the deposit, right? But once that storm wipes out all the competition, it's easy, and next thing you know, he's like owns Apple computers or whatever. So I think there's going to be people that get that kind of Bubba Gump effect where they are able to capitalize on these and outperform everybody else because they're buying up distressed assets or find opportunities that others can't see, right? Same thing with hospitality. I didn't do hospitality, but hotels struggled for the past year, and they're going to continue to struggle this year, but there could be opportunities for the right buyer. All right. Industrial. So, industrial. All right. So this was from the Cushman and Wakefield Q1 2021 Industrial Market Beat report. This was their opening line. I thought it was kind of said it all. So the U.S. industrial market started 2021 stronger than expected, with demand outpacing supply for the first time since Q2 2019. In fact, in the first quarter alone, the market absorbed 82 million square feet, which is the most space ever absorbed in a first quarter of any year reported by Cushman and Wakefield. So industrial is almost as hot as the single family home sector right now. Maybe not quite that hot, but it's hot. And they saw double-digit gains in 2020. It's just been performing really well, and it's can continue to perform well for the next 5, maybe 10 years. Vacancy is low. Asking rents are up. Rent growth is up 7.8% year over year. So there's a lot of opportunity in industrial, especially in the short term, I think, if you can capitalize on it. So the big challenge, I think, as I understand it right now in industrial, is finding land to build on that, suits their needs. But if you own industrial right now, you're sitting pretty. You're a very happy customer because it's performing better than pretty much anything else. So that gets 2 thumbs up. All right, so that's going to do it. That is the Q1 market update with the economic recovery rundown. I'm also going to be publishing a report that has a lot of this information, but kind of expands on some of it. So look for that in the next week, the Q1 Mach 1 report. So I've shifted that and these updates to a quarterly update, since I think it's just a little bit more demand. I think a monthly was just too much. So that's what we're going to be doing going further. And yeah, what questions do you guys got? We'll roll into the Q&A now if you guys have any questions, and we'll get into that. So what do you guys got? Ravi, you raising your hand? If you got questions, throw them into either the chat box or the Q&A box. Dealer's choice. Anybody? Bueller? Well, we often don't get questions. People are shy, but I'll just kind of leave it with this. I think that overall, the last month, especially with that jobs report coming out with almost 1 million new jobs, I think April will be very, very telling. So the new report will come out probably May 6th or 7th, whatever that Friday is. is when it should come out. So I'm going to be looking at that to see how April performed. That's going to be post stimulus. That's going to be really when the economy, I think, started opening up and you started to see a lot more outdoor dining and things like that. And that's really going to start to move the needle, and the vaccinations picking up and the caseload coming down. Because remember, the winter was a little bleak there for a little bit, especially that December, January. The caseload was really high and the vaccination rollout was a disaster. So now I think looking ahead, it's much more encouraging on that front. And as the economy opens up, I think people are just ready to just get back to normal, right? And just get out there and eat and make up for lost time. So we're going to see things really come back. When purchasing, this is a question from Kenny, when purchasing new property, have you had any issues with evictions? Yeah, like I said, I think it's really going to be property dependent, and what asset class you're in, and if you're in a C class multifamily versus an A class. But the thing with the eviction moratorium, and the reason I said that it doesn't have that much teeth, is because they need to specifically cite how COVID has affected them. So, and if you just look at rent collections on a macro scale, you're talking a 1.5%, 2% dip in rent collection. So overall, it's certainly not, it's not having an outsized effect on everyone. I don't think, from what I can tell, the apartment community isn't having a meltdown over the eviction issue. Seems like you can still do evictions in a lot of cases. They're just maybe still challenged. I would say it's probably a lot more challenging than it was a year ago, but I think overall people are weathering it, as far as the information I've seen out there. Good question. Let's see. All right, guys. Well, thank you for making some time with me on a Wednesday night to discuss real estate and the State of the Union. Look for, I'll be doing webinars every month. So you can check me out. If you're signed up for this, then you're going to receive the replay of this in the next 24 to 48 hours. And then, like I said, sometime in the next week, I'll be putting out that economic report. So that kind of goes hand in hand with this, just provides a little bit more color and an actual written reference for you guys. So that'll come out in the next week, and I'll have another webinar. I haven't decided my next webinar's topic. I might go back to basics for next month and do sort of a multifamily fundamentals. So if you guys are interested in that, let me know. Or if there's a topic that you'd want to hear about, then let me know and I can research it and do a webinar on it. Something I've been kicking around, maybe a 1031 exchange webinar. Sometimes you hear about that. So yeah, just let me know what you guys want, and I can usually make it happen. So, all right. Well, I appreciate you guys coming. Check me out on mach1equity.com, and hope to see you guys at a future webinar or connect with you guys. You can go to my website, fill out an investor questionnaire, and that'll prompt you to set up a introductory phone call so we can chat about your specific investment goals and needs and things like that, and see if there's some synergy there in any way that I can help you. So, all right, guys, take care. Enjoy your week. Have a fun weekend. Cheers.